Welcome to SFVN. Today, we will talk about the important issue of commodity trading. This is margin. The presentation will be divided into two main parts. Part 1 is concept and classification. Part 2 is margin management. Part 1 concept of margin in commodity trading. What is margin the commodity trading? Firstly, margin is an amount of money that must be available with the trader before opening position. Secondly, it is considered as a financial guarantee for performance of obligations as committed by related parties. Finally, the trading margin level for each specific future contract are issued and announced by MXV from time to time depending on market conditions. For example, we have the December wheat contract traded on CBOT. Initial margin is $3,630. However, this is not the entire contract value. Based on the contract specification including contract size, we can calculate the contract value. Here is $40,300. Thus, the initial margin level accounts for a very small, about 9%, part of the total contract value that we can buy. This means that you only need to spend a small amount of money to buy the entire contract value. Next, we go to the classification. We will learn how many types of margin are important in commodity trading. Here, we have total of 4 main types of margin in commodity trading. Initial margin, margin requirement, maintenance margin, variation margin and other. Firstly, let's learn about the initial margin. Initial margin is the minimum margin must be available on commodity trading account. Initial margin is determined based on the price fluctuation of underlying asset. The more volatile the underlying asset, the higher the initial margin requirement. Take a look at the two pictures below. Both images are initial margin levels publicly announced on the MXV homepage. On the left is the margin in VND, on the right is the margin in USD. Secondly, margin requirement. Margin requirement is the minimum margin must be available on commodity trading account to secure trading obligations including opening and maintaining open position. Margin requirement level is also used to secure trading obligations including opening and maintaining open position. We have a formula to determine the margin requirement. The required margin will be equal to the initial margin multiplied by the margin coefficient. Current margin coefficient is applied by MXV for business customer is 1.0 and for individual customer is 1.2. Third, maintenance margin. Maintenance margin is the minimum margin that must be available on commodity trading account to maintain open positions. Margin requirement level is also used to limit the risk if any parties fails to perform its obligations in futures contract. Another concept to keep in mind is net margin value. Net margin value is the total balance of commodity trading account, including account balance at the beginning of the trading session, deposit, withdraw during the trading session, actual gain, loss incurred during the session, and expected gain, loss at the determination time minus transaction fees and other fees. Currently, MXV applying a maintenance margin equals 100% margin requirement. Fourth, variation margin. Variation margin is the amount that the investor is required to add the commodity trading account in order to return margin level to margin requirement. And it make the margin balance always remains liquid so future losses are deductible. The formula to calculate variation margin equals margin requirement minus net margin value. Individual customer B of trading member A would like to trade the WTI crude oil contract, NYMEX. The customer B's current margin balance is $13,000. After B bought one lot WTI crude oil futures contract 05, 2022, The price fluctuated adversely, causing an expected loss of $8,000 in the account. Trading fee is $15 United States dollars per lot. And we have solution. We will go to the last part is margin management. Accordance with the regulations of MXV, if the margin ratio during trading session lower than 100%, trading member notify customer to deposit margin. And of the margin ratio less than or equal to 40%, the treatment measures are additional deposit margin or compulsory position settlement. In addition, a very important level that MXV mentions in the regulation is the 70% level. If the margin is less than or equal to 70%, then MXV will cut the pending orders contained in the customer's order book. Example: statement at the beginning of day have a margin of 54%. In session, if margin rate reach 40%, customer's position will be settled part or all to bring the margin above 40%. Here's everything for today. Thank you for watching.